Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say or do should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of January 19th, 2025. And in this week's episode, it's just myself, Sprocket888, and I want to take a look at a couple of trades that have gone bad for me. And they are some losers that I am currently managing. And those are in Snowflake and Coinbase. And effectively, I keep on rolling them, but they are deep in the money and it is not the best situation. And I just kind of want to talk you through what that kind of looks like, because not every trade you get to put on becomes a winner. And this is exactly the type of scenario that you go into a trade knowing that, hey, this could be the worst case outcome. And I'll just show you where we're at with that and how it's panning out so far. But before we hop to that, I want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading. Love to hear what type of content you want to hear about. Also, you'll find a link to thetagang.com/sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. Last, this is available in an audio-only format wherever you get your podcasts, so look us up there, subscribe, and if you can't find it, let us know, and we will get it there. But let's hop to this week's content. In this week's episode, it's going to be a relatively short episode, and this past week was the monthly expiration of January options, and there was a couple of losers that I was kind of rolling, and I thought, let me just take this episode of this week and let's talk a little bit about those losers, how I got there, how they're going, where I'm taking them, because a lot of the content that you end up hearing about here on YouTube or on the internet and stuff like that really focuses on all the trades that are going well. And that's just not the reality of how trading works. Yes, it would be amazing if everything always worked out as winners all the time, but that's not true. You're going to have some losers, and you have to have a strategy and a plan for dealing with those losers. And in my trading style of selling premium, I have a process that I go through for the losers, because I sell premium, unprotected premium, why I have a risk of assignment. And basically going into that, I will not take assignment at expiration. I basically will try to force early assignment. And what that basically means is when I sell an option premium and that option strike is breached and that option is in the money, I will basically play chicken with the train. And the reason I do that is because going into the trade, I am comfortable getting assigned, whether that's assigned on the call side or assigned on the put side, depending on what type of naked option I happen to sell. So getting assigned is something that is okay by me. However, I don't want to just, fold shop and say, great, assign me, I'm done. So I will basically roll those options forward to upcoming months, because you can always roll for a premium. You pretty much never roll for a loss. And the reason for that is because you're going further out in time and you're doing the same strike price. So you're effectively, whatever the intrinsic value is, basically the cost of in the money, you're both selling it and buying it back. So that's a wash. So the only difference in the option premium when you do that roll transaction is the extrinsic value or the time value. And you're always buying back to close the option that's expiring in the very near term, and you're selling the option that's further out in time. So it's going to have more time premium. So you always can do that for a profit. And you might think, well, great, how can you ever lose? And I would say the loss from this strategy, one, I guess you can just get completely run over and the price never comes back. So you will forever be rolling and forever be basically collecting minuscule premium if it keeps kind of going past your strike and deeper into the money. That's usually not the case. Most of the time you come back close to your strike or you come back out of the money or things like that. But what you lose out on is what I would call the opportunity cost, because your capital is now tied up in this trade. And once you breach a strike and once you go in the money, a lot of times the buying power really expands and the premium that you get from rolling really is not that much. So your return dramatically drops, and you'll see that in this episode. The other thing is, as that buying power expands, that is capital that you cannot use in other investments. or in other trades. And so sometimes that opportunity cost becomes very high. Now, this honestly is something in my strategy that I have not really factored in. And so I guess you could say that I am probably shooting myself in the foot a little bit because I'm not folding on some of these. And you'll see one of these trades has really, really expanded in buying power, but I'm still rolling with it. And that's somewhere that's a big chunk of opportunity cost that I'm kind of giving up in my strategy of roll and roll and roll again. So this really is just an episode for you to say, look, here's somebody that something went against them, and this is the situation that they happen to be in. And so we're going to take a look at two trades that I put on, Coinbase and Snowflake. Both of these I had put on as strangles. So I basically sold a put and a call, and both of these things ripped to the upside, just blasting through the call, which is pretty much the worst case scenario for any sort of premium selling. So if you go back to previous episodes or you've watched the show a lot, you will hear me say that there is nothing more dangerous than selling a naked call. Because once you breach that call strike, the amount of climb that underlying can have is infinite. There is no cap, right? Some people will say it's just equally dangerous selling the put side, but I would argue at least the put side has a floor. You can't go below zero. So you can go to zero, but you can't go below. But on the upside, there really is nothing that will stop you on the upside. Additionally, your volatility typically declines the higher and higher you go. And so as the volatility declines, you're going to get less and less premium on each of those rolls. So pretty much the worst thing that you can have happen is sell a naked call and have your strike breached to the upside and continue to be in the money on the upside. And that's really what these two positions we'll talk through today as far as Coinbase and Snowflake, as they have been breached and I am deep in the money on the call side. All right, so the first one that I want to take a look at is Snowflake. And I'm not really going to go into all of the entry things and stuff like that because that's not really what this is about. But we're going to start by looking at the return chart, or basically each of the trades that are linked in this sequence of events. And this really started out with an earnings strangle back in mid-November. And at that time, I had sold 113 put and a 145 call. And the idea was we were elevated in volatility. The earnings trade, I was looking for a volatility decline, and then largely not a lot of price action, probably staying within the expected move. That is absolutely not what has happened. Snowflake absolutely blew through the 145 call. I think getting up almost to $200 as an underlying. So I mean, we're talking $55 in the money almost, which is huge. And I sold 3 of these contracts. So this really was kind of not a great situation. And so you'll see I basically started out by $3.52 on each of those contracts. And I've shown you the open and close. And then the total. It's just a little bit different than I've shown on these charts because I kind of want to qualify the premium that I'm collecting on the front and then the premium that it's costing me to close it out. And that very first one, the reason that you see such an expensive close is because after the earnings, it blew through that. So it was deep in the money. And so that close cost included all of that intrinsic value that was then injected into the options that I had sold. And you'll see that basically the diagonal between that close at 30 or 27.35 and the next open of 28.75, that's just rolling the call side. And so the intrinsic value basically was in this cost of the close, and I sold it again in the cost of the open. So that's the wash. And the difference between these two strikes is basically the premium that I was able to collect of extrinsic value. So that is the time premium, and there wasn't much of it because it was so deep in the money. And then again, at the end of November, I basically took the earnings trade of that week, then rolled it out to the monthly expiration. And that monthly expiration expired, and I rolled again. So this 2004 and 2204, you can see there was basically $2 in extrinsic value. There was basically $20 worth of intrinsic. So it was probably trading at 165 at the time that I rolled those, basically $20 in the money. And then again, I rolled in mid-December at the December monthly, collecting again the delta here. And currently, the last one, I haven't closed it because I just rolled this last week, is that 145 call. That we'll see. I don't know that we will actually get below 145 strike here on Snowflake. So it's likely there will be just another roll here. And what you can see is this first hit thing. This is where I took the big hit, the big loss. But you can see everything after that is more premium, more premium, more premium. So the idea here is that I just keep rolling this, and bit by bit, nibble by nibble, I chew down on that premium that I basically lost in that initial breach. And then the idea is that at some point, this thing will get close enough to that 145 strike, or even out of the money is the most ideal, where it will lose all of its intrinsic value and trend more towards zero, and I'll be able to get all of this back. Now, the likelihood of that happening is relatively small within the next month, but it's something that I'm just going to kind of keep out here rolling. So where are we with all of this? So if you add up all these columns, you're basically looking at about $2,700 in premium that I have collected. That includes that $7,100, $7,200 loss that I sucked up right out of the gate there on that first earnings trade. Now, this thing has expanded. Originally, this was only about a 4.5K buying power, but because we have gone so deep in the money, this thing has expanded to about 15K in buying power. So this is that opportunity cost that I am missing out on. So you can see, the amount of premium that I'm collecting from these rolls is very, very tiny percentage-wise. And so that is one of the negatives, or one of the cons of kind of the way that I approach this. However, it still is a respectable 18% return on capital the way it stands now. Now, realistically, that number is going to go down, 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 because this is going to keep kind of going out in time. And so that's going to be basically divided up over a longer and longer and longer period. So that's where Snowflake stands today. Now, just before I move on to Coinbase, I do want to flip over here to the chart just to show you what this looks like. And so what I've done here is I've got the chart of Snowflake. You can see right here where there's two red boxes to the left. This was the original strangle that I put on. So price was trading right here around 130 going into the earnings announcement. And then this is just where we took off like a rocket ship through my strikes way up here, 170, 175, just totally breached it. I let this put expire worthless, so I got all that premium there. This next red box, that is the next call that I rolled of that 145 strike. So this bottom here stays the same at 145 because that's where the strike is each time. So the first red box was the first roll, the next red box was the next roll, the next red box is the next roll. But you can see, honestly, these boxes shouldn't have a top. They do have a top, but they go up to infinity. So that's, really where we're at looking at this, where I really need this thing to come back down close to this 145 strike. Ideally, I would love to come back below that. But the price action, the charting, this just doesn't look good for me. It looks like something that I'll get kind of tiny nibble, each and every roll that I put in here. Snowflake has just been incredibly strong. You can see we popped way up. We kind of came down. We bounced off. So we'll see how it goes. We're kind of approaching right here where this swing took off. So maybe we'll get a little bit of a reversal here. But if we kind of go through this 175 level again, that probably is not going to bode well for my particular position. So the next trade that I want to take a look at is Coinbase. Now, Coinbase, we'll go ahead and we'll pull up the chart on this. This was basically originally, it wasn't an earnings trade. It was something that just really had elevated volatility. This went on just pre-election, so just before the United States elections at the beginning of November, specifically November 1st. Which was just a day or two before the actual U.S. elections. As you know, Coinbase is a crypto area, crypto space, and that thing just took off like a rocket ship after the U.S. election and the Trump victory there. So, I guess I knew that was part of what was playing into a lot of the volatility. I was really hoping to see a lot of that volatility really evaporate and not a ton of price action, but that is absolutely not what happened to Coinbase. So we started this one out at 155 put, 240 call, and this thing just boom. I mean, flew. And I'll show you in the chart in a little bit. Just an absolute rocket ship through my call strike way above, to the point that one of the trades that I did right after that was go inverted. And I'll show you this on the chart. But basically, when you sell your put above where you sold your call, you basically have an inverted strangle. And I did this to collect more premium because this thing went through so strong and so far. I wanted a different avenue to try to collect more premium because the rolls were really, really not going to be that profitable with the depth of in the money that we were on Coinbase. And I'll show you on the chart what that really looked like. But you can see that very first trade that I put on, I collected 1432, and that thing, like I said, just blew through that 240 call, and it cost me. I only did one of these contracts because this was a very large underlying going into the strangle, but cost me $7,500 to close that trade because it was that deep into the money. And you can't look diagonal because this trade here on 1113 was actually just a short put. That was my inversion trade. So the diagonal that you have to look at is that 75.38 to 79.45. That's that roll of that monthly expiration. So I put this strangle on at a monthly expiration and was able to roll it out to the next month. And that difference between 75.38 and 79.45, that's the difference in extrinsic value. So that's that positive premium that I'm talking about that you get to collect when you roll a trade forward because you're basically selling more time. And then again, this really didn't come back down yet. So I rolled it again last week out to the February expiration for another 42.42. Now, this is one where the buying power has just absolutely ballooned. And part of this buying power ballooning here is a function of one, the size of the underlying, but more importantly, it's the amount of volatility in this underlying combined with how far in the money it is. So this thing is now consuming 43K of buying power, which is 10x the buying power that the original trade took, that original strangle. And this is kind of another caution when you sell option premium unprotected, because that buying power, depending on the underlying, depending on the volatility, can dramatically expand. And if you don't have an account that can absorb that expansion and deal with it, you're going to get a margin call. And that's something that I have learned over the years, that I keep about 50% of my portfolio unallocated in trades, because at any one time, my unprotected premiums could go deep in the money and my buying power can skyrocket. And I don't want to be in a margin call situation. And basically, a margin call is just when your broker says, hey, you've got too much risk in the market for me to be comfortable. So you either need to deposit more money or you need to close positions. And if you don't, I will do it for you. And that's not something I ever want to be in, being forced to close positions and take losses that I might not be ready to take from my strategy perspective. So, this is something I take into account when I open trades, because remember, I have to be okay with assignment. I have to be okay with the buying power expansion, and all of those factors. So these are all things that go into my decision matrix before I enter these trades. So let's take a look at where we are, and then I'll bring this up on a chart to show you, because this one gets a little complicated because I sold that extra put in there to collect a little more premium. But we started out with the strangle. That is where I booked that big $6,100 loss. Now, I booked that because that's where we totally breached the strike. And to close that out, I had to basically pay all that intrinsic value. Now, I got that intrinsic value back when I sold the next option, but we're still in the money. So until we come back to that strike or we go out of the money, that intrinsic value will kind of forever be tied up. And so the only part that I'm really nibbling away at is the little bits of extrinsic value in each of these rolls. So that first roll, was about $4 in extrinsic value, 75.38 to 79.45. And then again here, we got a little bit more extrinsic value when I closed for 30 and then rolled for 42. So that was $12 of extrinsic value that I nibbled back. And then I got a nice bonus here of 1734 of extrinsic value back because that expired completely worthless. And so I'm kind of nibbling away at this initial $6,100 loss. And I'll just keep chipping away until I kind of get that clawed back. And again, this is where that opportunity cost kind of comes into your calculus. For me, this is how I approach my strategy. For you, parking that 43K of buying power on the side and having that tied up might not be okay for your strategy. As you can see, the return on capital here has dramatically gone down. If you add up all this stuff, assuming, and this is a big assume here that I'll get this 42 back in the next 30 days. Unlikely that will happen, right? It's probably another roll and another roll and another roll, just like in Snowflake's case. But if I did, then I'm still looking at about 11% return on capital. Now, that gets a little bit worse and worse and worse. Now, the buying power probably isn't going to expand, but the amount of time that capital is tied up will, because every roll is another 30 days that I'm probably in this trade, and another 30 days, and another 30 days. So you have to take this percentage and divide it out over the length of time to really see what that return on capital is on a monthly basis. So these two trades I am absolutely not super happy with. They're not like, hey, refrigerator material, want to put them up there. But they are in reality something that can happen. And it's something that my strategy and my outlook does account for as I enter these. So let's go ahead and take a look over at the chart here of Coinbase, just to show you kind of what happened. So right here, is where we entered this. Now, we entered this as a volatility play going kind of into the US elections, looking for crypto to kind of unwind a lot of its volatility. That is absolutely not what happened. It rallied up going into the election, then the election happened, and we just basically almost rocketed another huge percentage up. So, remember, my call was at 240. Like, that was the top side of this strangle. And this first red box is the put that was out there, and this top red box is the call, at least the first top red box. So we breached that strike, and then we breached and got deeper. We got all the way up, basically $100 in the money. I mean, just huge in the money here, up to 345. And this big spike here, this is where I opened up that put. So this really tall red box here, which overlaps, this is the inversion that I'm talking about. So you can see this was at 280 put, which was, $35 above my call. And this is what's called inverted, when your put is above your call, which is not typically what you want to trade. But in this case, I really needed to try to claw back some premium. And as you can see, the price action, we came down, we touched it. We didn't really breach it. Then we kind of came back up. Anyway, this ended up expiring worthless. And so I kept every penny of that premium. That was at $17.34, which really helped me start chewing into that $6,100 initial loss of closing out this strangle. Then this red box is the first roll where I rolled from monthly to the next month. You can see that we got really close to closing it out here. I probably could have closed this for a scratch, but I wanted to kind of keep this going. There was a pretty big reversion. It appeared to be kind of a reversion possibility, although we've recently rallied up again as we're coming into the inauguration of the new president. So everybody's getting super optimistic. The market's risk on trade is back, and this basically forced me to roll again. And so that's really where this next red box is really coming into play. And we're going out even further now into February. So we'll see how this kind of ends up trading as we keep going. But again, this is really highlighting that this happens. And I'm going to keep rolling. I don't fold up and just look for assignment. I will force the other person to take assignment early. And sometimes they will. Particularly with both Snowflake and Coin, we are really deep in the money. So Coin is trading almost at $300 a share. That's $60 in the money. So it's very possible that I'll wake up one day and be early assigned, and I will be short those Coinbase shares. And I'm ready for that. And if that happens, I will turn around just like a covered call and I will start selling puts, which is effectively a covered put, which isn't a very popular strategy, but it is a way to keep collecting that premium and keep chipping away at that initial $6,100 loss that I took there. And this is where and how I manage and battle a lot of these trades. So that brings us to the end of this week's episode. Just wanted to take a few minutes here to really talk through the practical application of what it looks like when your premium selling strikes are breached. You go deep in the money, what the rolls look like, what that does to your buying power, and really how it plays out. And it's something that you really have to get used to because, to be honest, the first couple times I went through this, it was really stressful for me. And it was something that I wasn't super comfortable with. And it's something that I kind of forced myself to learn and force myself to see what happened. And that's really where I learned that you don't get assigned instantaneously. In fact, it's super weird to me that we can go this deep in the money and still not take early assignment, which is really where I got more and more comfortable with playing chicken with the train, because the longer I wait closer to expiration, yes, the higher the probability of early assignment goes, but also the less time premium there is and the more the roll can be worth. And because I'm okay with assignment, and it all starts with that. It all starts with you have to be okay with assignment. Because I'm okay with that outcome, there really isn't much risk on my side of taking it closer and closer to expiration, because I'm okay with the outcome if I play chicken with that train and it hits me. Because that is something that my strategy is prepared to do, and I do have a plan in that case, and that allows me to get a better and better roll price. So a lot of times I will end up going to the day before, or almost even the day of expiration in some cases, before I execute on that roll. It really kind of depends on what the price action of the underlying is doing, because again, the lower that price comes, or the closer to the money it comes, the better or kind of less of a hill I get from the intrinsic value. And really it's just a mental hill, because like I said, that intrinsic value in a roll really is a wash, because you're doing the transaction at the same time, buying the close one and selling the far one, and they both will have the exact same amount of intrinsic value. You're basically zeroing that out. You're paying for that intrinsic value when you close, and you're immediately getting it back when you open the next position. And the net benefit for you is the difference in that extrinsic value. And that extrinsic value is the time premium. And your one that you're closing is always a shorter time premium. So that will always have less value. So you will be able to close out for less, and the one that you sell in the future, you're going to get more money because there is more time, more premium. That is why in short premium selling, you always, always, always can roll for a profit. So hopefully that helps add a little bit more context to things. Like I said, it's not something that you can find a lot about on YouTube videos and other traders and stuff out there, because I don't think a lot of people like to show the things that don't work the way that they're supposed to. I think it's a lot more glamorous, and people like to make videos on the big wins. I also think people like to watch videos more on big wins, because they can say, oh, that could be me, that could be me. And I just think these type of videos are not very popular. So I probably will not get very many people looking through or watching this episode. But for those of you that really want to see a little bit of reality, that's exactly what this is. The presidential inauguration is this week. More volatility is sure to come. There's been a lot of uncertainty in the market thus far as interest rates, inflation, and there's been a real push-pull from risk on and risk off and risk on and risk off. In general, the market is incredibly risk on right now. And it has a very high time, or a very high premium to earnings across the market compared to historical norms. So, will the market grow into that valuation, or will we prove to be overvalued? I don't know. In the meantime, I'm going to go ahead and keep my premium selling strategy, which is largely independent of the strength or weakness in the market, because it really just is about the volatility. So as long as there's volatility out there, I will sell it. As long as there is time premium to cash in, I will sell it. And that is my strategy, agnostic of whether or not the market's going up, down, left, right, or wherever it is going. So hopefully you are finding something out there that you're interested in trading. Good luck out there. And remember, think outside the block.